Greetings, Keith Prather here again with the NCM RV Demand Index, or else Economic Outlook, but I'm showing you the demand index for this month. And again, remember, the demand index is like a leading economic index. It just gives us an idea of what demand for the next 6 months ahead is going to look like. And it's interesting because we did get a bit of a surge, and you can see that this continues a 2 or 3 month increase in RV demand, or at least the dynamics and the market environment that creates good demand. And if the signals are correct right now, we're seeing an index that looks elevated. Now, as I said in some of the other videos across some of the other NCM sectors, we have just a little bit of a concern that maybe some of the data that we were getting coming out of April was a little bit elevated. We know that the federal government can go in and make adjustments to that data anywhere from 1 to 4 or 5 months in advance or into the future. So we could get a revision next month on the data. But for now, we did get a decent month-over-month growth rate from March to April, and then we're seeing it about 20% higher year over year. And as a lot of you are hearing, we've got the same debate raging behind the scenes that you're probably hearing on showroom floors. Is this consumers trying to get ahead of tariffs and they're trying to make purchases? Is it dealer discounting and those deep discounts that are trying to create a better demand environment? Um, we don't have an answer for that, but what I can tell you is what this index measures is the capacity in the industry, the capacity of consumers and households to make RV purchases. Whether they're motivated to do that or not is something a little bit different, and that's where the discount rates at dealerships, that's where that comes into play. We're just telling you that the environment moving ahead is conducive for improvements in sales. Let's say that's probably the best way to say it. Okay, so right now getting good signals out of this demand index overall. When we look at the retail sales index, then a little more sluggish though than what the demand index was showing. The retail sales index showing a little bit of improvement, 3.5% higher month over month, and was still almost 14% higher year over year, but it's going up against this trough that we had in April of 2024. So it's kind of a low point, and then we saw growth, a lot of that seasonality, but a lot of growth into the end of the year or into the kind of Q3 right before October. So this could be some of the same cycle, but we're starting at a much higher rate than we were a year ago. So that's a pretty good sign. And again, this 3.5% month over month growth rate is positive. We just don't understand fully what's driving it. But I want to show you over the next couple slides just the economic fundamentals that are underpinning growth rates seem to be very supportive of people going out and making purchases. So I've shown this across most of the sectors as well. I just want to show you that from a consumer spending perspective, when we think about consumers showing us their willingness to spend money, this is really our first indicator after the April 2nd tariffs hit as to maybe what the impact on retail sales will be. Now, I expect this curve to improve. I expect it to move up like this in the coming months as we get brand new data and we show that maybe the tariff impact was less than expected. I think there was a lot of fear in the marketplace, and a lot of that fear kind of translated into what we were seeing in economic data. If you think about what happened with like the S&P 500, or think about what happened with the Dow Jones Industrial Average, and we saw that plummet in April, losing thousands of points. It's since rebounded, and we're kind of coming back up to where the S&P 500 could be approaching some new all-time highs at some point, maybe this year. But that period that we went through in April and early May, and that fear is kind of what's built into the models at the moment. That's why you get this downturn, you get this real sharp adjustment that looks like it comes sometime in July, August, September, October. Again, I think when we get new data, you're going to see this flatten out a little bit. I think it'll be closer to this upper bound here, which from a bottom line perspective just tells us that we have a much stronger consumer than expected, and the consumer is still doing well, and the consumer is still interested in going out and spending. In fact, I don't have it in the presentation this morning, but just this morning we got a brand new mid-month Michigan Consumer Sentiment Survey, and consumer sentiment is starting to increase. It continues to ratchet up. So there's more optimism about what's coming in the second half of the year. It could be hopium, right? I hate to kind of say that, to borrow kind of a crass term, but but it could be hopeful optimism that we're going to see the second half of the year be a lot better. But we'll see what happens. So the Federal Reserve, when we think about RV sales, one of the key things will be interest rates, and I know you hear that a lot. Interest rates being too high keep a lot of buyers on the sidelines, don't bring them back into the market. But what the Federal Reserve is getting is a little bit of confusing data because, as I said early on, remember we got really cool inflation readings this week. So we got a cool consumer price index and a cool producer price index. But again, as I talk to manufacturers and importers from a lot of different sectors, what I'm hearing from them is they're still living off of and feasting off of existing inventories that they bought before tariffs were an issue. What's coming is, even for some of those countries where we have a 10% tariff, some of that tariff has got to be passed on to the consumer. In the case of China, where you have 55% tariffs on today, any of those components coming from China that come into a lot of products, especially a lot of RV manufacturing, will eventually have to work their way into the system. And we could start to see those tariff increases a little bit later in the year. The bottom line is we may not be feeling it yet. And that's what has the Federal Reserve concerned. They've got good GDP growth rate and they have a fairly stable job market. Those two components are typically enough for them to trim interest rates. They don't have to do it in a panic way. They don't have to go get aggressive about cutting rates because they're getting growth without it, but it also doesn't spur them to move. What would spur them to move is a low inflation rate because then they could say, I've got tame inflation, and if I weren't afraid of it increasing over the next couple of months or next couple of quarters, they could drop the interest rate and still spur top line growth without triggering inflation. And so that's what they're kind of concerned about. So I have a feeling this keeps them on the sidelines. Right now, if you look at the market sentiment, the market believes that in September we'll get a quarter point cut, and then maybe in December we get another quarter point cut. Now, for RV sales, since they're bigger ticket items and they typically have a longer term of borrowing, we look at some of the longer term interest rates, and those will be tied to things like the US 10-year Treasury, sometimes the 5-year, 3-year Treasury. And right now, those are still ratcheting up. Bond markets hate deficits and they hate inflation, and both are kind of scaring the bond market at the moment. The inflation data this week kind of helped the bond market feel a little bit better about themselves. We saw yield rates come down just a little bit, but not enough. We need to see those yield rates get below 4%. Right now, they're hovering at about 4.4, 4.3%. When that happens, when they go below 4%, suddenly we see mortgage rates go from 6.8% closer to 6% or below. And once they break that 6% threshold, a lot of consumers will free up spending. And I know in the RV sector, we've got a lot of different demographics now buying RVs. And a lot of them are going to be sensitive to what happens in the stock market, which it has improved. A lot of them will also be sensitive to what happens with interest rates. And that's also, if we see some movement in that, that should spur more foot traffic on showroom floors. We'll see what happens now in July. We're kind of circling that as a critical point because we're expecting to get, the administration has said that they're going to negotiate brand new trade deals with only the top 18 trading partners. Everybody else is going to get a pretty blanket tariff impact of maybe 10% or less. Um, but we're going to get these trade deals between now and July, and we'll understand them a little bit better. We'll understand what's in them, how much the market it frees up. Some have estimated that maybe by the time we get done, we're going to see a $350 billion annual boost in U.S. exports. Just if we look at the UK trade deal alone, we got about a $25 billion boost in exports. So that helps lift a lot of U.S. business. That will help create a lot of momentum for some U.S. manufacturing, agriculture, the automotive industry, a little bit in the aerospace industry, defense. And as you start to see those industries do better and start to rebound, that gives their workers a lot more wherewithal to go out and spend. It gives them confidence, right? And these trade deals are long-term agreements. Unlike a tariff where the president can swipe it on and swipe it off, these trade deals, the way they're doing them, they have stickiness, right? They stick for a long time. And so corporations can make longer term decisions based on what they're seeing coming out of the trade deals. And that will help them with hiring and that will help those those workers in those industries feel more confident about their future, and then they'll go out and they'll take on longer term borrowing. So that's one of the reasons why the demand index is starting to show that pop and starting to show it improve a little bit. The sentiment's popping up. So let's hope. We'll know, and we'll put out our next set of videos early in July. Hopefully, we'll have a lot more of these deals announced, and we can break them down and understand what the real impact will be. We'll understand what's happening with tariffs a little bit better, and so we'll have a better reading for you. So for now, we still don't see recession anywhere. We see the full year growing at about 1.5%. Again, even when we keep Q2 at current expectations for 1%, we're getting growth signals in the economy, as I said earlier, that are closer to 3.8%. I think those will come down. I think those will cool off a little bit as we get brand new data, because I think the data is going to get a little bit tougher as we see the impact of tariffs. But for now, it looks like pretty good signals all the way across the board. So we'll see what happens. Again, we've got a lot of moving parts out there at the time of me recording this on Friday morning. We were only 12 hours into the Israeli attacks on the Iranian infrastructure. So oil prices had jumped about $7 a barrel. But, we think if this follows a lot of historical trends and patterns, if it doesn't explode into all out war, there's going to be this hype period, and then it'll hit a peak, and then within 3 to 4 weeks, we'll start to see the oil markets cool off a little bit, and oil prices will come back down, and then the price at the pump will come back down. So hopefully we don't get these price spikes and shocks, and we don't see oil go to $100 a barrel, and see those fuel price shocks to the market that can kind of impact the RV sales. We have historically seen some sensitivity in the RV industry to what's happening with diesel and with gasoline prices. So we'll just have to watch those items. It was still breaking at the time I was recording this, but again, we'll have an update for you in several weeks anyway. So until then, hope everyone have a great time, be safe, and we'll see you next time. All right, take care. Bye bye.